We've all seen crypto wallets evolve from um, these simple storage vaults into something much more. But I don't think anything quite prepares you for the sheer scale of what we're talking about today. Exodus Movement Inc. is making a massive play. We're talking $175 million to fundamentally dominate crypto payments.
It's so much more than just a big purchase. This is a complete strategic replatforming. I mean, it's all about total control. Exodus has a definitive agreement to acquire W3C Corp.
And W3C Corp, just for you listening, is the parent company of two really key players, right?
Exactly. Monavate and Baanx. And these aren't startups. These are established providers of the card and payments infrastructure that a lot of fintech and crypto clients are already using.
Okay, let's unpack that, because our whole mission in this deep dive is to figure out why this move, what everyone is calling vertical integration, is such a watershed moment.
It really is.
We're moving way beyond just holding crypto. This is about controlling the entire process of spending it.
That's the perfect way to put it. Imagine the crypto world and the traditional retail world are on opposite sides of a canyon. What we're watching is one company trying to build the bridge and all the plumbing to connect them directly.
So Exodus is the wallet we know for self-custody.
Right. You control your keys. But W3C Corp, through Monavate and Baanx, they bring the machinery, the actual card issuing, the processing, and navigating all the really complex regulations.
And they're doing that across multiple continents.
Oh, yeah.
We should probably mention the timeline, too. This isn't happening tomorrow.
Not at all. The deal's subject to regulatory approvals everywhere, and it's not expected to close until 2026.
That long timeline alone tells you just how complex this is, all the legal hurdles they're jumping through.
It absolutely does. They're essentially buying their way into being a globally compliant payments provider, and that just takes time.
All right, let's dive into our first section, the strategic pivot. If this all goes through, what does it actually mean for someone using Exodus?
Well, the outcome is that Exodus positions itself to be an on-chain payments giant. It becomes one of the very few self-custodial wallets that controls everything, end-to-end.
From the wallet interface.
Straight to the physical card in your hand. It's a full-stack maneuver. And the goal is twofold: operational efficiency and expanded utility.
So instead of paying some third party to handle card issuance or compliance,
they become their own supplier.
Yeah.
They gain all those issuing, processing, and regulatory capabilities instantly.
And the vision, you can just hear it from the CEO, JP Richardson. He said the goal is to make crypto payments practical for everyday life. And he said they're closing the gap between holding and spending. That last part feels like the key to this whole thing.
It is the key, because historically that's been the clunkiest, most expensive part of crypto. How do you get your assets from, cold storage to actually buying something at a store?
So what specific infrastructure are they bringing in-house?
They get the whole underlying card and payments stack. This massively reduces their dependence on outside providers.
Which means they can build new features faster, right? And they're less exposed if a partner suddenly changes their rules.
Exactly. And crucially, it lets them support a much wider range of assets, especially those widely used payment stablecoins. That's where the daily utility really is.
But hang on, doesn't every major wallet already support stablecoins? How does owning the card stack change things for the user?
It changes the speed and the cost dramatically. When you rely on a third party, every single step, the compliance check, the currency conversion, the authorization, every step adds a little bit of time and a little bit of cost. By integrating all of it, Exodus can potentially offer, instant settlements and much lower fees when you convert your stablecoins to fiat at the checkout counter. They own the whole engine.
And we're talking about real global utility here. The sources say Exodus will be able to issue cards through Visa, MasterCard, and Discover.
The major networks we all use every day.
Plus, they're expanding their reach across the US, the UK, and the EU. That is serious global ambition. And it's all built on acquiring existing regulated companies.
It is. And, this isn't happening in a vacuum. It follows their acquisition of Grateful, which is a stablecoin payments company in Latin America.
So there's a clear pattern.
A very clear pattern. They are systematically building, as they put it, the rails to roll out modern payment products. They're assembling the whole toolkit, piece by piece.
Which brings us to our second section, the financial side. Building these rails is expensive. $175 million is a huge price tag. So what's the return? How do they justify that cost?
Well, economically, the CFO, James Granetska, was very blunt about it. The money they'll make from interchange, processing, program fees, That is expected to become a foundational part of their business.
So it's a huge shift.
A crucial shift. They're moving away from relying only on, the volatile crypto trading revenue. They're adding a more predictable, almost institutional style revenue stream. They're buying predictability.
It's about diversifying, building a recurring earnings base that's tied to the everyday use of digital dollars.
Exactly. So they can profit from the steady drip of daily transactions.
While still being able to ride the waves of crypto market volatility. That seems like a really resilient combination.
And it's not a guess. This is grounded in hard data. The demand for stablecoin payments is exploding. Volumes went up 70% just between February and August of 2025.
70%.
Wow. And here's the kicker. Nearly 2/3 of that volume was B2B payments. It's businesses demanding these efficient rails even more than consumers buying coffee right now.
That B2B detail is so important. It shows the real value might be in enterprise solutions. And you can see how this benefits their existing business lines, like XOSwap.
Immediately, XOSwap customers who already account for a huge chunk of their volume can now add these new Baanx and Monavate capabilities.
So they can offer things like programmable payouts and turnkey card issuance to other businesses.
Precisely. Think about what that means for their big partners, like MetaMask and Ledger. This isn't just for Exodus's own users, it's infrastructure they can sell to power the rest of the industry.
So this all comes back to that concept, vertical integration. It sounds like a Wall Street buzzword, but why is controlling the whole stack, the wallet, the processing, the cards, why is that such a big deal in finance?
It's a strategic imperative. I mean, it fundamentally streamlines everything and gives the user more control because you're getting rid of all the friction points where money or data has to jump between different companies.
Fewer intermediaries means less can go wrong.
Less fraud, less data leakage, less regulatory confusion.
Can you give us an analogy from traditional finance, something that's easier to grasp?
Sure. Look at embedded finance leaders in France, like BNP Paribas. They've integrated services lending, payments, insurance, and they embed them directly into other platforms using APIs. They control the whole customer journey.
Or in tech?
Think of Foxconn. Their vertical integration in AI infrastructure lets them build and deploy complex solutions incredibly fast because they own everything from the supply chain to the final assembly. Exodus is applying that exact model to crypto payments.
It sounds incredibly centralized, though. We started this talking about self-custody, this idea that you control your own keys. Now they want to control the rails, the cards, the whole experience. Isn't that sacrificing the decentralized ethos?
That is the fundamental tension here. It's a critical question. They're trying to create this seamless, self-contained system that honors the ethos of crypto. You still hold the key, but solves the massive usability gaps that have held back mainstream adoption.
So they're centralizing the spending layer for reliability.
You could say that, yeah.
Is there a crypto analog for this? Where else have we seen this kind of integrated build-out?
You see it in places like Blockstream's Bitcoin ecosystem. They have the Liquid network for fast settlements and the Core Lightning network for micropayments. It's an integrated approach to enhance efficiency, even if it adds some centralizing elements.
And the market for this is huge. The embedded finance market in France alone is projected to be, over $16 billion by 2025. This isn't a niche crypto play.
Not at all. It's a play for a substantial global piece of the future of finance.
Okay, but every big bet like this comes with massive risks. When you try to become a payments giant overnight, you're going to face some hurdles.
Major hurdles and major scrutiny.
Let's start with a big one that affects everyone. Regulation.
That's the biggest hurdle, hands down, navigating regulatory uncertainty. The rules for digital assets are wildly different in the US, the UK, and the EU.
All places they want to operate.
Right. And even in a market like France, regulators are constantly pushing for more transparency and consumer protection. Exodus has to build a system that can adapt to shifting rules without breaking. That's a huge ongoing cost.
And there's a pretty big financial risk baked into how they're paying for this deal, isn't there?
A very significant one. The $175 million price tag is being funded with cash and financing from a credit facility with Galaxy Digital. And here's the crucial detail for you to understand. That credit facility is secured by Exodus's own Bitcoin holdings.
Okay, wait, hold on. Let me get this straight.
Yeah.
They are collateralizing their entire future growth with an asset that can swing 10, 15% in a week. Is that normal for M&A?
It is not normal for traditional M&A, no. It's a very high-stakes crypto-native strategy. A traditional loan would use predictable assets as collateral.
Not a volatile crypto asset.
Right. Using Bitcoin means if the price drops, their collateral ratio changes. That could lead to margin calls or force them to sell BTC just to keep the deal alive, a deal that won't even close for 2 more years. It adds a whole new layer of market risk.
And finally, what about the tech, the scalability? Can this new integrated system actually handle the kind of volume they're talking about?
That's the billion-dollar question, isn't it? I mean, while some blockchains like Solana are fast, the broader adoption of stablecoins still faces technical limits. Their success depends entirely on being able to handle millions of daily transactions without compromising security.
Right, the security people expect from a self-custodial wallet in the first place.
Exactly. It's a massive technical challenge.
Yeah. So let's bring this all together. This massive acquisition is the signal that Exodus is moving from just being a wallet to being a full-stack financial provider. It's kind of mirroring the evolution of traditional banks.
That's right. They're controlling the whole value chain, from storage to spending, but doing it with decentralized assets. It is a huge, high-conviction bet on the future of on-chain payments.
They're trying to finally solve that real-world usability problem and capture the predictable revenue that comes with controlling the infrastructure.
And if they pull it off, they'll be a dominant cornerstone in decentralized finance.
This deep dive has really shown how a company is trying to bridge that gap between volatile crypto and everyday spending. So for you, the key question this all raises is this. If they're successful, will controlling the payment rails, the infrastructure, eventually become more valuable and predictable than the crypto assets themselves?